Good day to you, everybody joining in. It's your boy Tony. Welcome, ladies and gentlemen. We are live and we are jumping in right before the New York session here. So it's been an incredible run. We've had quite some significant moves already, basing off the fact that the Federal Open Market Committee stayed with the 3.75% interest rate, and a lot more is happening. Okay, so we come into the end of April. This is the second quarter, and from a seasonality perspective, that simply means a lot of things. Many of the moves could get very, very violent around this time. However, I'm here to break down what many of our retail traders are facing, right? Some of the challenges that, that I see, because institutional participants have a completely different way and perspective of looking at these charts. Now, ladies and gentlemen, if you're just tuning in, you are more than welcome. We'll be doing these live streams quite often and digging into the actual practicality of how we trade. All right. So if you're out here and you're looking for some kind of knowledge, please join the chat and ask your questions. The stream is not for someone looking for a signal right now. Okay. It's not for someone who wants to know what to buy today. We're not doing that. Okay. What we're doing is we want to get ready, right, for the actual wrong moves. What do I mean by that? Many of you have been trading for a significant amount of time and still your results are far from good. All right. So I would like you all to jump in, drop into the chart right now and tell me how long you've been trading for. Could be one word, like a month, a year, 2 years, 5 years, it doesn't really matter. All right, let me see some people in the room. We have an open chart and we're going to start breaking that down. All right, ladies and gentlemen. So what are some of the mistakes that retail traders are making? All right. When I look at most retail traders, what do they do? All right. Let's just take a chart here. Okay. What are they doing? They open a chart, let's say a gold chart, right? And they are trading this chart, just the chart, not the market. There's a difference between that. There's a big difference between trading a chart and trading the market. Okay, it doesn't matter if it's a currency pair, a measure, right? It does not really matter. This is just a visual expression of what historically transpired. Okay, doesn't really matter. You can open any chart and you'll still see the same thing. Right? So, error number one is trading the chart, not the market. This affects almost every retail trader that I've seen. All of them. All right? You are trading the chart, you're not trading the market. Now, I know that this sounds, of course, it sounds like, of course I am using the chart. And this is what trading is. I get it. It's candles for retail traders. It's indicators, a bunch of indicators and things like that. So that is what charting is. I get it. Trading is reading the market. The chart is just one representation of it. And remember this, just like any other indicator, it's a lagging one. All right. So if we take an example and look at this chart, the Australian dollar, Canadian dollar. What do most people see when they look at this? What are you seeing? I'm quite sure you're seeing a support zone around here or here, all right? You're seeing a resistance right here, right here. You're seeing some candle patterns, right? You're probably seeing a trend line right here. I get it. And you are probably seeing an RSI. So if you go to the indicator and you put in the RSI, let's look for it. Right, and you're seeing this RSI from here, let's say right there. You're probably seeing a divergence, right? It's probably on, say, a bigger time frame. Let's just put the 15-minute. You are seeing some kind of divergence, right? So this is what almost every retail trader that I know is doing. Now, what they are not seeing, what the chart physically cannot show to them, is why price moved to those levels. This is number one to know. How did price move from over here up until over here? Fine, you might say that we had buyers in control. I get it. Buyers, and you're probably using supply and demand. That is all fine. But you could ask another question. Why did price move from over here up until over there? It's not easy. What will happen? Traders are often their own sort of making decisions based on a document that describes pot as if it predicts the future. Now, there's a big problem with that, right? For example, we had the FOMC data coming out yesterday, right? And if you go check out what really transpired, as much as we got the 3.75, if you go and check the voters who actually disagreed, right? You could see that the Board of Governors of the Federal Reserve System voted unanimously to maintain the interest rate paid on reserve balances at 3.65%, effective of April 30th, right? So, if you start to check Dipper, right, there is already misalignment, right? There is a lot of misalignment and information. Why I'm just saying this is because we had FOMC yesterday. And pretty much many retail traders don't even bother to check out this fundamental news. All right? Don't get me started with the correlations that we're going to come to in a second. Now, this is another thing to understand, right? It's very important that you understand that the chart simply is a prediction. When a retail trader is using this, it becomes very, very hard to predict moves. Now, here's a very specific cost of this error. By just using a chart and a few indicators, you are missing the entire story. For example, if you're around this time, right, we know that according to our time, it is 8 a.m. in New York, right? We're getting into that hot zone. Now, when price approaches a level, let's take for an example, we have a level right here. If price approaches this level right here, say on the 15-minute, right? And you start to sell because the chart says there is a resistance here, right? You've looked at this part, you've looked historically, and you actually see there's probably a support that has turned into resistance. I get it, right? Most of you would do that. Let's just take an average trader. Now, if you're doing this because of this technical charting experience that you have, but you did not check what the chart cannot tell you, and what can the chart not tell you, right? Is whether that support or resistance level is actually a pool of resting orders that the institutional participant is specifically targeting. All right? Now, not to be rejected from this area, but say to sweep through and collect the stop losses sitting right above it, including yours before the real move begins. So, if I'm to zoom right into this area on a smaller time frame, let's say the 1 minute, okay, you now start to see a little bit of more information on the micro level. But again, you can use all kinds of indicators and all kinds of confirmations, but what actually happened? What really happened? This resistance level was probably not a war. It was a target and a marked location where orders were concentrated. So there is this continuous battle between institutions and opposing forces, right? There is a continuous battle going on, and this is far from even an average trader's understanding of the entire architecture of how this entire system runs. Okay, so a marked location like this should not be your ideal or final confirmation. There are many factors that you should take into account before you even start. So stop reading the chart as a prediction surface, ladies and gentlemen. If you're using technicals alone, I will repeat myself. You might have a good strategy and a niche, but just reading the chart is wrong. You gotta start reading it as a liquidity map, right? Liquidity mapping. You have to ask questions like, where are the pools of resting orders? Okay? And we'll be designing some of these things, okay? If I open, say, this, where are the orders of, where are they? Right? If I open this, where do you think would be the next stop, right? Where are the equal highs and equal lows? Equal highs and equal lows. We are simply mapping out liquidity zones, right? Where are the gaps? Where are the gaps happening? And you got to compare with different liquidity providers, right? Where are they? Where is price likely to be drawn before any substantial directional move begins? For example, we have a push the entire Asian, last quarter of Asian, and then the entire London. Will price keep moving up to cover up all these zones that we had? So, these are some of the questions, right? That reframe from chart pattern trader to a liquidity map reader is, if not the single most important and biggest shift available to the average retail trader. It changes what you see when you look at the chart permanently. And this is what I want to start letting you all understand. You got to see differently. Now I'm going to check the comments and see. Guys, we are live, so you might want to go and make use of those comments. Somebody says, I can see some of... what does he say here? Okay. Ladies and gentlemen, please use the comments to ask questions. Now, another thing is, the next point that I want to put is using indicators. Indicators. You find so many retail traders using a bunch of indicators. So many indicators. You know, I'm not saying indicators are bad tools, and if you go check out my my channel, you'll realize that I've done a lot of videos on indicators, right? And the problem about indicators is you're using them as signals when they are only capable of providing context. So look at this chart right now, particularly we're having the gold chart. Okay, look at it. This is what an average retail trader sees. He will go and he will simply put in as many indicators as possible. He'll put that, he'll put that, he'll put that, he'll put that, he'll put that. So many. Let's just say. Okay? Having many indicators is okay, but imagine you have a situation where you have so many things and it just gets so complicated. Right? You don't want that. Okay? You have to have a backup reason why you are using these indicators. If you're using, say, an RSI, a MACD, a moving average at once, you're using Bollinger Bands, and maybe you're using some custom indicators, right? Someone just sold it to you and you are reading the signals of these indicators. That is not analysis. It's pretty much like you're managing noise and they're losing. So, indicators from experience only work if you're using them for context. You should never use indicators for analysis. And that is a very hard pill to swallow for many. Okay? So, I wanted to say more about the indicator. Every indicator that you use on your chart, or rather that I've ever used, every single, is simply a mathematical function applied to price data that has already happened. You will never find a predictive real-time indicator. It is simply not there. For example, if we look at this RSI, what is the RSI telling us? The RSI is telling us that it's just showing us how fast price moved in the past, right? In the past 1 minute, for this sake. If you open a MACD, imagine you are trading like this. You have demarker, you have bear spar, you have Arun, you have accelerator, oscillator, and so forth. That is just simply so much noise, right? If you're using a MACD that's telling you the relationship between two moving averages of past price, you're using Bollinger Bands that is telling you the volatility range of the recent past price. Okay? That is not how you do it. None of them can tell you what price will do in the next 1 minute, because if we had any indicator that could tell us that, we'd probably make a lot of money. Now, this raises an obvious question. If every indicator is derived from price, why not just read price? Have you thought about that? Why not just read price? Why not just read price? And the answer for most retail traders is, well, you know, because price is very uncomfortable. Price does not have a number that says overbought or oversold. You're probably going to stick around the psychological levels. Price does not give you a clean cross signal that tells you exactly when to enter. Okay? Price requires a level of interpretation. And interpretation requires a framework. Now, it doesn't matter what you're using. If you're using all kinds of lines, okay, for your analysis and so forth, most retail traders, because they were never given a proper framework, replaced it with indicators. So as you continue in your career, you start to make more mistakes. And it's very hard to unlearn some of these things as you get older or you gain more experience, especially if you're winning at the start, or rather you're getting you're having good results. Okay? Now, what happens when I strip everything? This is what happens. When you strip out everything and you're used to indicators, a very big problem arises. Okay? You get so confused because you have gotten your eyes very, very fond of these indicators. But when you strip it off from the start, you can see structure at all the levels. Doesn't matter if it's a micro or macro, you can see some kind of structure. Higher highs, right? You can see lower lows, all right? You can see impulse candles, bigger candles, smaller candles, and so forth. You can look at imbalances as well. So these weeks where price pushed into a level and was rejected, and then we had that drawdown. Consolidation zones, be it static or dynamic. This is where energy is sitting. So what I'm trying to say is it is good to use indicators, but not as your signal. When you're looking at charts, all the information was there before. The indicators were sitting on top of it. And they added complexity, not any kind of predictive analysis. So, the fact that you're using that does not show that you're getting prime signals. You're simply adding reasons to second guess without adding any information that was already visible in the price itself. Okay, that is important. Now, how do you fix this? You got to fix this by removing every indicator from your chart except one. If you're using one at all, then only use the one as a filter, right? Not as an entry trigger. I talk about some of the indicators and I give reasons why. And you'll see me time to time, all right? You'll see me time to time adding maybe 3 indicators, but with a reason. Okay? For example, a specific candle close, a specific structure break, a specific sweep and reversal at a defined liquidity level. Everything else is sort of noise. All right, ladies and gentlemen. The next mistake that I see. The next mistake that I see, all right, is risking more when you're confident. For example, we have a very interesting calculator here. Many of you are using the standard 1 to 2%, okay? But if you get too confident and you use more, right, because you made a win, okay? That will ensure that you start making mistakes. If you start to size up without any sort of analysis, all right? Monday morning, let's say you are fresh. I understand the week is new. You have a setup. It looks very clean, and you take the trade. Let's say the macros are aligning. Right? Macros are aligning. Let's say the macros are aligning on Monday, okay? And you have a setup. Let's say you've seen this double bottom, right? And you wait for all the structure to play, you know, and then you take this trade up to here, right? You've made a certain amount. You've looked at the macros and it aligns. So this is Monday. Now you begin to size up you think that the price will eventually drop. All right. Let's say you double your size here, you get in, and then you have your target somewhere down here below these stops. And bang, the reversal happens. And usually these reversals happen with so much momentum. You've probably doubled your size, 2x, 3x. Now you're in a loss. Now the emotions start. Now you're slightly less confident, right? And what is funny, the irony about risk management is the more you lose, the more aggressive you become, because it takes slightly more to win back what you lost. Okay? So, by the time Wednesday comes, you are probably down. Your loss is doing a lot of mental damage, right? And everything just keeps getting hit. Your stops losses keep getting hit. And by the end of the week, mathematically, your average win is smaller than your average loss. This is the pattern that destroys accounts, right? That have a legitimate age. It has never been the market. It's not the strategy. It's just the variable sizing, all right? Variable sizing. Now, I give this trading journal, and how to fix it is simply by journaling everything here, right? Let's say you take a euro, right? Sorry, Australian Canadian dollar. You take the short, you enter the date, the exit date, the stop loss, and peeps. We talk about a lot about R, the risk, the result, the gain, before screenshot, after screenshot, and it calculates for you your AT trading, right? And of course your strike rate. So by doing this, if you manage to reach 100 trades, you have already intuitively built some kind of risk management system, right? Now, not forgetting the martingale table. It's free of charge. How do you carefully use risk, right? It calculates for you the amount of stakes that you can use, and using all these together over time will definitely keep you in the game. Now, I talk a lot about these because these are basics, and as much as they're basics, they really, really help. So a good idea, right, is in order to increase your win rate, you have to build your confidence back, and that requires a lot of discipline. So, using a lot of and predefined risk is a problem. The number one rule that I apply to every trade here, right, doesn't matter the currency pair, okay, is you gotta calculate your R. R is your risk unit, and I usually use 1%, okay, 1 to 2% of my current account equity. So if it's 120, the equivalent to 1% would be 1,200. Now, you gotta calculate it from your stop level, all right? Not guessed. Applied regardless of how confident you are, okay? So we're going to look at an example. Let's say you have on the higher time frame, okay, we don't have any data there, but let's check the daily. Fine. You have an idea, trading idea, okay? You, for some reason, think price will go up there, okay? We are currently hovering around the 1.037 zone, okay? And you think that price will break the previous high, okay? We've calculated 1% is 1,200, okay? Your risk unit of the current account So this is all you're going to use. This is your R, your risk unit. We're going to calculate the risk unit, right? What we want to do is go to this martingale and place the deposit, which is 1,206, and it will calculate for us the stakes. So we simply have about 5 steps, right? 5 steps. The first being 0.03. So what you want to do is get that properly. So we'll have 24. So $24 will increase it to $60, then to $134, then $303, and then $683. So if it's 24, then you can go back there and then place the $24. Okay, 24 is what we're going to risk. Go back to your smaller time frame and check that out. Say you go in for a buy. It's a 1 minute. Okay, usually you do this to test the markets. Testing the markets with just a simple hypothesis like you've seen, right? I enter the market with the lowest risk, anticipating that we'll get the high. So let us wait for that. We have about 30 seconds. So what I'm trying to do is run you guys through some quick risk management strategies on your risk, right? Because this way you are guaranteed for longer term gains. All right, the confident trade and the uncertain trade get the same R. It does not matter because your confidence is not a predictor, right? It's your process, all right? So there we have it. So we have only lost $24, ladies and gentlemen. What do we do next? Okay, what do we do next? What we're going to do is simply go to the next level, which is step 2. Step 2 is 60 backs. We're going to go back and try to use $60, right? And we keep the strategy. So I'm getting in $60 and we simply wait. At the end of the day, you will notice that your strategy has nothing to do with your P&L. It could be I could work out a 38% win rate with the right proper risk management and still make it. So these are some of the things that are very crucial when you are trading. Okay, so there we have it. We have a breakdown, but that doesn't really matter because we have full confidence in our system. Every hand again, right? We're all human, guys. The market knows it. The fix is just making the decision before the emotions rise. So do not rely on any emotional state. Okay, now somebody might argue that here we have broken structure and now we're moving down. Okay, so we lose 60. That is fine. What do I do next? I go to my risk management table. Now we're increasing. This is 134. Go back there. 134. Now I probably tested the market. I want to reduce it to 15 seconds. I am so confident that we're still going up. I'm risking a much bigger lot, all right? 15 seconds. And we want to see what really happens. Because on a higher time frame, we probably made our assumptions. There we go. $257, guys. So we have not only made back our initial stakes, which is 60.84. We've made back everything and we are in a profit. Now in that way, you can choose to keep going or stop. So these are some of the risk management systems that we can use, like the martingale system, right? So feel free to go check out the link in the bio. Next is the economic calendar, guys. Many of you are using Forex Factory and all the other open source data for reading things like CPI and NFP releases, right? So I get it. You see the numbers coming out, all right, and you quickly run to your chart to place the trade. I get it. Let's say CPI drops, right, at tomorrow. Let's see, do we have any CPI tomorrow? Okay, pretty much nothing. But let's say we have any other news related number coming out. We have the CPI comes out, it drops, right? Most retail traders look at the economic calendar from an opinion on what the number will be. They usually look for the forecast, and that is what they're going with. If this comes out positive, then the correlating asset becomes more valuable, and hence the trade is based on that sort of fundamental fragile hypothesis. I get it. I've been there, many have been there, but most retail traders who do this are losing, right? You got to go deeper. You got to start breaking down some of these numbers. Start to investigate why. What are they affecting, right? I talk a lot about these things. For example, producer price index, the news release summary. You got to be able to tackle down each of these dimensions, some of these groups, foods, energy, everything. Everything is intertwined. This is how you become informed over time, right? You have to look at the historical trajectory, and you can base some of your predictive analysis on that, right? So at the end of the day, guys, more information, all right, doesn't necessarily equal confusion, right? You have to know where to get the data from, all right? Now, we've seen how we've broken down risk and also a little bit, a pinch of fundamental. So, guys, with time, you'll understand this is not bad luck. It's just a mechanism. We decode it all the time. News releases is not a starting gun. It is a delivery mechanism, right? So the position that you've built before the release by participants who were reading the bond market, for example, right? Get used to these things. Get used to them. You know, you're checking out government bonds. You are checking out, for example, we have oil, right? Oil. Look at that drop in oil. Why did it happen? What was this got to do with yesterday's FOMC meeting, right? You can open the statement and try to identify, or if you watch the press conference, what was their sentiment towards the geopolitical war and everything like that. So it starts to make sense gradually. So you're not just wishful thinking or gambling, right? When the release confirms your thesis, then you are in a much better position. So looking at these sorts of patterns, even before events, is price consolidating on a lower time frame? Are there price spikes aggressively in one direction? Okay, is there a breakout? All those questions. Where is the reversal? Now, you gotta do this. I know it's boring, but with time, it starts to make a lot of sense. You do not trade releases, you trade the reaction to the release. Do you have a strategy around the way you are trading news releases? All that stuff is very important. All right? All that stuff is very important. Do you have a strategy? Do you have a wait, hold time strategy? Are you waiting 15 minutes, 30 minutes? Now, the most interesting one is holding winners. You're holding winners too short and your losers too long. Let's say you get in for a swing. Okay? You get in for a swing and you think price will be back. For example, right now we are in a floating profit. We have a floating profit here, right? Now, what does a sensible trader do? What he's going to do, right? What he's going to do is what he's going to do is simply move his stop to break even. That is what he would do. Actually, you would start to scale down. And I talk a lot about this as well. Scaling down, right? Do not be so aggressive. Look at the time. It's Thursday. You want to take some of those profits. Like, there's so many things that you should learn before you even start trading. I'm going to look into the comments if you have any questions. This error, holding winners too short, is a very interesting one because it's purely psychological, pure human wiring. And this is one of the biggest reasons why your account is not growing. You're closing your winners early and you are holding your losers too long. We call this loss aversion. And it's not a character flaw, it's just neuroscience, guys. We know that research consistently shows us that the pain of a loss is approximately twice as powerful psychologically as the pleasure of an equivalent gain. So, if you gain once, right, on a neuroscience psychological level, right, the emotions that you get are not as powerful as if you lost once. Okay? Which means your brain, the perfectly normal, well-functioning human brain you're using to trade, is hardwired to do two things that are directly destructive to profitability. One is protect the small profits at all costs. You're protecting your profits. The moment a trade is in the green, even if the trade is still far away, the urge to lock it in is overwhelming because you are not used, you're not comfortable. Losing the unrealized profit would hurt. Two is avoiding to release your loss. Let's say you're in a loss. If you notice that system that I just showed right before your eyes, it's a system and it's controlled by principles, right? So, the moment a trade is in the green, even if the target is still far away, just like we have here, okay, we still have a long way to go. What many people will do will either lock right now. But what you're going to do is scale down and ride along, okay? So, a strategy that could have been a positive expectancy that could make you money over time produces losses instead. Not because the analysis was wrong, but because the management of the outcome was asymmetric. So this is how to fix this. The solution is brutally simple. It's to state and genuinely identify your system. Predefine the target before the trade is open. Predefine your stop before the trade opens. Let the trade run to one of those levels. Do not exit at a round number along the way because it feels safer. Do not move the stop farther away because the trade needs more room. Do not close early because the market is simply making uncomfortable noises. So, you have a plan, trade the plan, ladies and gentlemen. Okay? One practical addition is if you are struggling with early exits, and almost everyone does initially, I get it. Do not match the trade after it is open. Don't watch it. Just set your stop, set and forget. Set the target, set the alert for the invalidation level, and then close the platform. As simple as that. We'll be talking about this further. Okay? I'll be breaking down other mistakes. This is part 1. We're going to look at ignoring the macro environment entirely. Alright? We're going to look at that as well. And many other interesting things. So, welcome guys. This is an interesting stream. We're going to keep streaming these things, and I'll be breaking down some of my perspectives, my ideologies, and why I'm so consistently profitable. Thank you, ladies and gentlemen. see you in part 2.
Yo, listen, oi. Run that again, I'm shelling them. Flow galactic, cool man Bellingham. Man, I got love in Krakow and Birmingham. The gal love me, but I keep hurting them. I'm a twat, got the chat. Bit of this and bit of that. I'll run up in New York with a Polish nurse. By the time we're done, it won't be your flat, like flat.